Marcie, thank you so much for being here with us. Really excited to talk about CalPERS and how you guys are approaching private investments. I think just to start out, I'd like to start out kind of high level. How are things looking so far this year now that we're moving into March?
Thank you. And thanks for having me back this year. We pulled into the hotel last night and it was like, wow, a year goes by really quickly. So for us, the portfolio is looking quite nice, actually. As of the end of December, our year-to-date returns were sitting around 7.7. We have a 6.8% return target. And so we're sitting pretty good there. And just a lot happening around the globe, as I know you all are paying equal attention to as you're trying to figure out how you position your portfolios or what deals you take on, what deals you just have to walk away from. But overall, the portfolio is doing quite well.
What are some things that are kind of concerning you so far this year?
Well, geopolitics, just politics here in the U.S. We're a strong climate investor, and so there's been quite a bit of criticism about the fund's investments in climate technology or the transition itself. We actually have a congressional investigation into those investments, and so I won't talk a lot about that other than our posture is one of being very neutral. We're happy to educate on how we're investing the portfolio around climate. We had made a sustainable investing 2030, $100 billion of the portfolio. And it's really split into two areas. One is a calculation of the current holdings. So which of the companies do we think we could overweight because they're doing climate transition activities in their companies? And then also new deals, and some of those in venture and private equity. And I think Anton's on a panel later, and I know he'll talk a bit more detail about that. But climate is certainly a theme for us. Emerging and diverse managers remains a theme. This is the DNA of CalPERS. And I think what we have discovered through our own investments, through our manager selection, of which we are quite diligent about, is that the book performs very, very well. And I'll talk a little bit more about the private equity book itself. But emerging and diverse managers tend to outperform as long as you have good manager selection diligence. And I think our team has found that recipe. So those would be two themes for us. But geopolitical risks, additional inquiries on how the largest U.S. public pension plan is investing assets, whether that's diversity, equity, inclusion, whether that's the E, S, or the G, whether that is labor or unions' influence over the way the portfolio gets invested. We're answering a lot of questions and a lot of queries right now. But again, our posture is one of being very neutral, happy to educate, happy to share with you how we're doing this with full fiduciary responsibilities.
That's been such a big part of the program, emerging managers, diversity. And so how do you go about that, especially when it comes to private investments? Is that through fund-to-fund structures and things like that, or do you go through that directly?
So this is really about manager selection. So we're really in both. We're in fund-to-funds. We have relationships with TPG and Grosvenor in fund-to-funds. And then, our private equity team has done a really nice job of really kind of widening the funnel at the top, broadening the way that we look at managers. How do we get ourselves out there where we can hear, people be able to do their pitches to us? And I think that's something that over the last 2.5 to 3 years, the team has been really mindful about, is that we had been, I wouldn't say stuck. I'm not going to criticize, the GP relationships that we have, because those are very strong, but they were very concentrated, and we needed to move away from that concentration, not just in the buyouts and moving more to that middle market, but also in manager diversity. And what we have found through performance over, a relatively short period of time is those emerging and diverse managers are performing equally or better than our traditional managers. But we need both. This is not a criticism of either side, but we needed to broaden that funnel at the top and bring more managers in. And there's a lot of dispersion there. And that's where I think we can get more active risk return, is when we select those correct emerging and diverse managers in addition to our traditional managers.
Curious about what role does each play when we're talking about sort of the larger side of the market. This is private equity, and then the kind of smaller, the emerging side. What role does each of those play in the portfolio?
Well, they each have a role, obviously, and we're targeting about 10% of the private equity book at emerging and diverse managers. We think that is the right target for today, and there is there's no preference being given to any particular manager. But again, it's just making sure that we're doing the due diligence when we're selecting new managers to come into the book. But I think that has been really the recipe for success there. The traditional managers that we've had long-term relationships with, we are getting a little more demanding about the capital, making sure that we have some values, more values alignment. And I think we have a question later that I can talk a little bit in more detail about what those requests might be. But we need our GPs to be strong. We need our GPs to kind of withstand some of the political pressures that they're getting, in addition to, the political pressures that CalPERS continues to get. And, we just have gotten accustomed to doing it. And maybe, the spotlight hasn't been on a lot of our partners yet, but if you haven't gotten it, it likely will come your way at some point. But I think we found that being neutral, keeping a very, soft posture on these things, tends to work to our favor.
That's really interesting in terms of CalPERS sort of exerting its influence in a way. And could we get into that a little bit? Mm-hmm. When you say that, are you talking about sort of being on LPACs and having a voice in that way? Or could you talk about that a bit?
I think, for CalPERS, we're sitting, I think, about $615 billion in the portfolio. Our voice, in isolation has been enough so far. And for us, we've seen some of our traditional relationships get more involved in what I would say the big P politics. And, our request and the discussions that we have with them, and this is not a public shaming of anyone, but the discussions that we're really having with all of our relationships, not just in private equity, but CEOs of public companies as well, is that we really need you focused on running your companies. If you have an interest in being in politics, then exit the company, go work in politics. But those two things do not mesh well, and in particular at CalPERS. So these are some of the messages that we've been having with a lot of CEOs, whether those are private or public, and they've gone well. Whether that's a letter that we have with a private equity firm where we've said the cure is you got to jump back in. You got to jump back into your company, taking a leave to go work on something. That's not in our best interest, and long term, it's not going to be in their best interest either. In particular, when they're out doing fundraising.
And so you've seen that kind of intersection of business and politics. You've seen that happen.
We have. And I would say, not throughout the book or not throughout the portfolio, but there are singular circumstances where we felt that it was, significant enough where it got our board's attention, and the board is putting pressure on the team to inquire further or, other things. And so it's prompted us to have these conversations with our partners. And like I said, they've gone very, very well. And, working in the public eye, like CalPERS does, maybe we see things a little bit earlier than some of our counterparts. And so some of these have been a bit of a surprise that it got to us or that we had concerns about it. But the moment that we had that, real conversation, we sensed that there was a real willingness to look at things differently on their end. And we've been pleased with the response.
In situations like that, and I'll get off onto another topic in a moment, but in a situation like that, is the concern sort of taking full time and attention away from running the fund into something else, or is it concern more about this kind of public reputational issues?
Well, it depends on who you ask, because I think it's a mix of both. We have 2.4 million members in our system, and they come from all types of political backgrounds, but they become a lot more vocal. This stakeholder activism, or they've almost acted like they're shareholders more recently. If they see something, like, we're not headline investors or headline divestors, as I tell the board, but our members will get very active on issues, and they're very active on Tesla, as an example, right now. And I can talk about that one because that one happens right in our public meetings, and we have one coming up in March. And one of our board members asked us to do an analysis on continuing our investment in Tesla, and we have to report that back to our board in March. But that will not be an open session item because it really gets at investment strategy. But it's both. It's brand, it's reputation. If you have all been following CalPERS for as long as I have, you know that there was a real brand hit about 15 years ago. And when I came into the organization, I just started my 10th year in October. part of my time is to improve and repair that relationship and that brand that we have with our members. And so everything we do, everything I do is about protecting that brand and serving the membership. And so it is a blend of both. It's politics, and we need you to run your companies because we need you to get the value for the portfolio so that CalPERS is able to pay its benefits. And, we're $32 billion in benefits going out the door every year of that $615 billion portfolio. And I can talk a little bit about liquidity and why private equity still works for us, but I'll pause there.
You anticipated my next question.
Yeah.
Exits.
Yes, yeah. Mm-hmm.
So is CalPERS pushing hard on understanding the kind of exit outlook throughout its, I guess, private equity we're talking about here, its private equity portfolio? How are you approaching that situation?
Yeah. Well, I think, that those are conversations that Anton would be having. I don't get, directly involved there, but I know the team is just seeking to understand as we look at the capital outlay, especially in regards to TPA and the shift to total portfolio approach that the board approved last fall. So the team is talking, anticipating so that we know our cash flow. CalPERS, interestingly enough, we just, when I came into the organization, we were about 65% funded. We were able to announce earlier this year that we're roughly 84% funded. And the reason we went ahead and did a quarter forward is to pick up the private equity valuations that lag a quarter behind. So we are roughly 84% funded today. That underfunding has put us in a pretty good liquidity position, a cash flow position, where even though we have this outlay of the benefits going out the door, at $35 billion, I think it's around $35 billion, we still have good cash flow coming in where we're not selling assets in order to hit the payroll. So we find ourselves in a great position to be selective about the deals that we're taking, and in a place that we can understand because even though the money may not be being returned as quickly as what we had thought it might be or what was anticipated for it to be, as long as we can see value in that relationship value there, then we're okay with the exit being a little slower. I know Anton likely will talk about some of the secondary markets and some of the secondary things that we've done just to get the book back into alignment with the current strategy. And those have done very, very, very well for the team.
Yeah. Speaking of the funded level, your goal is obviously 100%. And so I'm curious about what role kind of private investment plays in getting it there.
It is a significant contributor. I don't know if you know, but I came out of the Washington State system, and it had a meaningful allocation to private equity from private equity's beginnings. And so I grew up, in that system. And so it's part of who I am. And I remember my first media interview, and they asked, well, what are you going to do about improving the funded status? What are you going to do about improving returns? And I remember answering that it's a solution around private equity. And then there was another asset class too that we're working on. But we have to have a more meaningful allocation to private equity, and not just a meaningful allocation, but we have to improve the relationships that we have with GPs. When I first came into CalPERS, I had a number of our great GPs who came to talk to me because I had been in Washington, came into CalPERS, and they came and just shared with me their experience with CalPERS, that we were inconsistent. And when Nicole came in as the CIO, she did a look back in our private equity program, and it ended up being fondly titled The Lost Decade. And it really was a lost decade of allocating. So the market didn't know whether CalPERS was in or whether CalPERS was taking a pause. Were we completely out? And during that entire 10-year period, you saw the losses in opportunity. And so we needed to fix that. We needed to be more consistent in our pacing, and we needed to up that allocation. And the board has supported us with that. They have done meaningful increases to the allocation in private equity. And you can't do that if you don't have a team that the board trusts. And we have an excellent team in place under Anton's leadership. And, I think the portfolio will stay meaningfully allocated in private equity, even under a TPA scenario.
And that's an interesting point there, TPA, because it sort of gets away from that idea of a rigid bucket for each asset class. Does that mean that I think private equity is 13% or something like that at CalPERS, somewhere around there? It's higher.
It's higher.
Does that change under a TPA framework at all?
It really does not. I mean, you can't do private equity on a deal by deal basis. You can't have it run through a governance system, no matter how quickly that governance system might be. They actually do have to have a forward-looking budget, and they need some independence to, work those deals appropriately. So even under a TPA, the board will receive a 3-year projection of how the assets will be allocated across the various classes. And so they'll also get a dashboard. Are we on track with that allocation? Are we off track? Where are we at with the active risk limit that they've given us, which is about 400 bips of their reference portfolio? So private equity, it will continue to have some headway that they can operate more independently and make those decisions quickly. Because that was also one of the criticisms I heard from GPs, is that you don't give us a quick yes, but you don't give us a quick no either. And we're waiting 6 months, 3 months, the fund's getting ready to close, and we still don't know whether CalPERS is in or out. So we can't have that situation repeat itself either.
Could you talk about the shift to TPA? Why go that route?
Stephen Gilmore.
Okay.
Right. So we, chief investment officers at CalPERS, I know you've noticed it. It's one of the things I've really focused on, is getting a CIO that'll stay in seat for longer than 18 months. I'm very happy to say that Stephen's been here 19 months now. So he made it through that 18 months. These are tough jobs. They're very public, and I think people really underestimate what it feels like to sit in these seats the first time that story gets directed on you, whether it's a decision that you've made relative to the portfolio, whether it's something you've done personally. You don't really understand it until all of that attention in spotlight gets focused on you. So Stephen came in and interviewed with us. He interviewed before the board as well, and really talked about some work that he had done both in Australia and New Zealand around a total portfolio approach and better collaboration, removing silos. The board really liked that. He thought also that performance due to collaboration and really looking at the cost of capital over time, evaluating that risk and return as deals are coming in, that it would improve returns over time as well. And he had very strong conviction about that. And the board expressed their support of him and that decision last fall. Now, they do want a lot more information, because as they're giving more of what they perceive as their delegated authority to the team, they want a lot more data showing how that delegation is working. So they will receive a monthly dashboard of all the things that they believe are important for them to monitor. But TPA really came in as a result of hiring our new CIO, and the board and me really wanting to support him. And we have a 2-year check-in on this to see how it's going. I don't think, we can't fully implement TPA in its full glory in 2 years. I think it's fair to do a 5-year assessment, but the board wants to do a full check-in at the 2-year mark.
And speaking of kind of delivering data around the program, transparency, especially with private markets, it's always a question.
Yes.
How do you feel about the kind of transparency level that you get out of private equity, even private credit?
So I'm comfortable with it. But, transparency is one of the criticisms that we hear, not just from our board, but from stakeholders who come before the board. They don't like that some of the information is not available to them. They want to see the limited partner agreements. They want to see everything. And that's just not possible in private markets. They're private, I say this, and they're private for a reason. And the reason is they have to outperform public markets. Now, if our portfolio is now not outperforming public markets, then you need to come and question why we're investing there. But transparency to the level that we can do, to the point that it does not detour returns or, interrupt returns, I'd say we ride that line very strongly. That, to the extent that we can share with our members what they own, that's something they want to know. Well, what do we own? That might be interesting for me to know. To the extent that we can talk about that, it's usually a timing issue, not that they can't know, but the deal needs to be closed. We have to have agreement with the GP, the other portfolio companies. But transparency is certainly a criticism, along with fees, and then along with, valuations of private equity companies that are not held publicly traded.
Another big question, valuations.
Yeah.
I mean, it it became something of a controversial topic a few years ago. And where do you stand on that? I mean, are you?
Yeah. I think we're comfortable. If we were uncomfortable, we would be engaging with our GP community pretty, significantly. I think ILPA is comfortable with this. Nikita is the board's independent consultant on private markets. They are comfortable with valuations. They believe that, there's been a couple of reports, and I don't have them with me, but which really show that, when these companies go IPO, relative to the valuation that they're being held in these books, they're pretty accurate. And so I don't have concerns about valuations, and I certainly am telling our stakeholders that every chance I get.
Have to ask about AI. Is CalPERS using AI at all throughout the investment program?
So we have this approach. So we're not really a leading group on AI, but the investment office is certainly using the productivity side of AI, the data analysis side of AI. Obviously we're calling it human-enabled AI, not human replacement AI. We work in a very strong union environment, so our posture there, we have to be really careful as well. But we're using it for productivity tools and really helping the team. Within the organization, outside of private equity, we're using it in our contact center. AI is doing the call summaries so that our agents can spend more time talking with the members, which is what they actually enjoy doing. So that's not been a problem. They enjoy that. Every employer that comes into CalPERS, we have about 3,000 employers. They have to go through this memorandum of understanding with us and making sure that all of the compensation and the reporting is in alignment with all the state statutes, and there are many. And so that was another great use case for AI. It's called Computron. But so internally, we are using it. I think the investment office is really using it for insights and data summarization, obviously overseen by our great team to make sure that the data is accurate.
So you're here in a room full of LPs and GPs. Anything that you would like to see GPs kind of do better?
Well, I touched on it briefly. We do need more data about some of the portfolio companies. And we did this data convergence project with Carlyle a few years ago. And I think it's time to refresh that. But there's just certain pieces of information that we believe we need to have more access to really manage that risk, making sure that our capital is being used appropriately and the company has every chance of success, and having those come in from an evaluation standpoint with us. So I think more GPs, more funds, more portfolio companies reporting data to us would be very useful. And what I can reassure you GPs is that public records are a deal, and we have an exemption in law that all of our private equity records are protected under state law. So providing that information to us, it just comes to CalPERS and is not available to the public wanting to come in and look at how you might be running one of your portfolio companies. And then the other one I touched on is just stay focused on your company, please. For us, to the extent that our governance structure can be very, very complicated, our board can react to headlines. And it makes it very difficult for me, for Stephen Gilmore, for Anton and the team. But stay focused on the company. If you're a GP and you're running, say, middle of the private equity book, and you've got some headlines out there, it makes it pretty difficult for us to explain why we're still in. So to the extent that you can help bring that noise level down or keep the noise out, we would really appreciate that.
Could you just briefly talk about that project with Carlyle?
That was about 5 or 6 years ago, and it produces, and we've got pretty good participation today. But I think it's time to look at it's EDCI. I think is the term for it. But it looks at workers' comp claims. It looks at greenhouse gas emissions. It looks at whether there's an engagement survey done in the companies. It doesn't say you have to report what your survey results are, but just whether you do one, yes or no. But there's a collection of data that we find really helpful when we're underwriting a manager.
Interesting. Okay. Well, we are quickly running out of time, so I wanted to make sure to get a couple questions in about your own sort of career journey and how you got here. I think the story of your career is very interesting. Could you just give us a brief?
Yeah, sure. The board, the board about 4 years ago asked me to start talking about this a little bit more. It's not something that, I talk about myself very often. But I mentioned that I came from Washington State, and I grew up in a very small town on the Olympic Peninsula called Forks, Washington. If any of you have read the Twilight books or watched the Twilight movies, that's where it was set, rainiest place in the United States. It gets about 120 inches of rain a year in the rainforest. And so I grew up there. I went to high school there, graduated high school, and then I moved to Olympia to take a 30-day emergency typist job. And I could type. I took all those business classes in high school. And that 30-day emergency appointment turned into a 30-year career in Washington State. And I ended right prior to coming to CalPERS. I was on the governor's cabinet, Governor NEXUS cabinet. He appointed me to run the Department of Retirement Systems. With that job, it put me as the ex officio member of the Washington State Investment Board. I became the chair of that board about a year in, and then 3 years later, I came to CalPERS. But I started as a typist, and I worked my way through the org chart across one agency in particular. But I've always found that my next step in my career, the next step in my job is finding the right leaders. I never really followed the money. I followed the leaders. And so I followed this leader who I had a lot of respect for about 15 years into my career, which brought me over to the retirement system. It was the best decision that I could have made. I wouldn't be at CalPERS otherwise. But it was, when I'm coaching people, I said, it's not a career ladder. You really need to think of the opportunities that might be a step across. You might think of it more like this career lattice where you're moving sideways to get a better opportunity, better leadership, better mentoring. And it's not always about compensation. And so that's how I've really handled my career, is working for leaders who were active mentors, active sponsors. When you're not in the room, they're the ones pounding the table for you for your next opportunity. And I just have had a number of wonderful leaders throughout my career who've really helped me to get to this position that I'm in. But I started as a typist, and I don't have a formal degree. I'm pretty open about that. And there's been a lot of questions about, well, how does someone without a formal degree get the job that you got? And the board, when I shared this in my interview, the board was proud of that. That was the term they used for me or with me. And, it's just been a decision that I haven't regretted. I really enjoy this role. I've been here almost 10 years. The longest standing CEO prior to me had been here 6 years. It can be a grind, just a lot of public scrutiny. It's a big organization. We run, a pension system, but we also are the second largest purchaser of healthcare. We have the $615 billion portfolio, but we also run about a $40 billion portfolio of our affiliate funds. So it's a massive operation, and you can't be successful in these roles without hiring and retaining a great team. And I was involved, in getting Anton to CalPERS or back to CalPERS. And that was the best decision that I've made.
Having covered CalPERS for many years, you definitely seem to have brought stability to that institution. Just somewhat boring on my end, but good for you.
Yeah, stability is nice. We want boring. Boring at CalPERS would be a really good day. That's what we strive for, is boring and consistent. And I think that was the problem that we had, is we've not had consistency in the CIO role. We need that consistency, not just in the CIO, but I need it amongst our managing investment directors, Anton included. And my job is helping to retain that talent and making sure they have a place where they can really learn, grow, develop others. They have interesting work. There's always interesting work to do, but they have an environment where they feel that I have their back, that I'm going to run this. Steve Hill was his name, and someone who I worked with and really helped me get into a relationship with the incoming governor back in 2013. And he just would always tell me, Marcie, where's the adult supervision? That's something you need to be paying attention to. You must be present to win. And you've got to figure out how to run boundary patrol. Like, your job is to run the fence perimeter and keep all of that stuff out of CalPERS so that your team can do their jobs. And I enjoy doing that. And there are days I feel like we do it pretty well. And then there are days that maybe, a fence post came down and something came through. But, I really enjoy it. And it's been a fast 10 years.
You also managed to raise a family during this career progression. Did you feel like you had to sacrifice anywhere?
I was a very young mother. I had two daughters before I was 20, and then I had a son when I was 25. So I was raising my family as a single mom for much of that time. And the sacrifices, sure, you have to make with spending time with your family. But all three of my children are very successful. They all have degrees. One has an advanced degree. She's a principal in a little town called Silverton, Oregon. But they appreciated that sacrifice. But I was always home for dinner. I didn't travel much. That was the one sacrifice on the work side. I just said I can't travel very much. But while I'm here, my 8 to 5, I'm all in. I'm present and will do it. But I had a good support system around me as well with my mother and my grandparents.
Well, we're out of time, Marcie. Thank you so much. This was great. I really appreciate you being here.
Yeah, thank you for having me. Yeah, thank you.
Thanks for watching. For information about PEI Group's entire portfolio of events, please visit peievents.com.